Hi, in this chapter we will discuss how stock market operates. Now, in the event that the thought of putting resources into the stock exchange brings alarm bells to your mind, then you aren't the only one. Because false guarantees and exceptionally open stories of financial specialists striking it rich or losing everything. Skew view of the truth of the normal speculator like you. But if you basically understand how stock market really works, then you will likely think that it isn't as alarming as you may think now, and that it's a feasible business. Now, the basic thing to understand is everyone says stock, buy stock. Now, stock is a share. Now, what is a share? Now, when you purchase a stock, you're purchasing a bit of the organization. That is basically you're buying an organization. At the point when an organization needs to raise cash, it issues offers. This is done through an IPO, in which the cost of shares is set based on how much the organization is worth at that time and what numbers of shares are being issued. The organization basically gets the chance to keep the cash raised, to develop its business, to expand its business, while the shares, likewise called stocks, keep on trading on the stock exchange. For example, New York Stock Exchange or Nasdaq. So basically, when you're buying a share or a stock, you're basically buying that company. You're the owner of that company. Either you own one share or you own 80% of the company. So basically, you are not gambling, you're buying something. Then, that company which has raised cash through that IPO is basically using that cash to expand its business because basically a company thinks it's an ongoing concern. So it will always try to raise itself to a better business. Now, what is stock trade and who are the participants in the market? It's not only you. Now, trading in stock market means the transfer of for money of the stock or security from a seller to a buyer. That is, let's say you're buying and I am selling. So the money goes from seller to the buyer. That is, the stock goes from seller to the buyer, but the money goes like on the opposite direction. This requires that the two parties, that is you and me, agree on a price. Let's say I'm saying I am selling a share at 13 US dollar and you are buying it at 13 US dollar. So we both agree on the price. Now equities, that is stocks or shares, means ownership interest in a particular company. That is, I am selling my ownership interest to you and you are buying that company. You are the owner of that company in the future. Now, market participants include individual retail investor like you or institutional investor such as mutual funds, banks, insurance companies, and hedge funds, and also publicly traded or corporations because they also trade in their own share. A company buybacks its own stock. So basically, it's you against all of these people that I have mentioned. You need to understand how do these people trade and why do they put so much interest in technical analysis or chartism and why you, the individual retail investor, doesn't even know about it. What the heck? Now, rates of participation in stock market and the value of holding differ significantly across strata of income. In the bottom quintile of income, nearly 5.5% of household directly own a stock, and 10.7% hold stocks indirectly in the form of retirement accounts. So basically, everyone owns. Some know it that they own it directly, and some doesn't even know that they own. The top decile of income has a direct participation rate of 47.5%. So basically, the 1%, the rich, has like half of their income invested in stocks, and an indirect participation rate in the form of retirement account that is nearly 90%. So if you look at it, the rich makes money through stocks, but the poor has only like 10% investment in it. So just look at the difference. The rich 90%, poor 10.7%. It's an 8 time difference. 8 times. Now the median value of directly owned stock in the bottom quintile of income is only $4,000 and $78,000 in the top decile of income. That is as of 2007, and the gap have increased ever since, because after the crash the poor got afraid and went out of the market, whereas the rich invested more because they knew the market is at the bottom. The median value of indirectly held stock in the form of retirement account for the same two group in the same year is 6,300 for the bottom people, or and the top, the rich, 214,800. That's a lot. That's like more than 30 times the difference between 6,300 and 214,800 US dollar. Wow, that's the difference between the top 1% and the bottom people. Now, the behavior of the stock market. From experience, it is known that investors may temporarily move financial prices away from the long-term aggregate price trends. Overreaction always occurs, so that the excessive optimism or euphoria may drive prices unduly high. You might see a stock going from 60 to 180, and you might say, what the heck happened? This is the same company. And the same thing happens when it falls. It falls exceptionally low. You might say, what the hell happened? And there might be no news. This is what makes crashes happen. Now, in a crash, a stock market crashes is like a sharp dip in share prices. Stock falls suddenly 30%, 40%, and you might say, oh heck, what happened? In parallel with various economic factors, a reason for stock market crashes is also due to panic and investing public loss of confidence. Often stock market crashes and speculative economic bubbles, that is the price rose from 60 to 180 without much of like earning or revenues. And then the crash came and it fell off to the same rate, let's say $60. Thank you.